All right, everyone. Today, we're going to dive into what is essentially the engine room of every single business, transaction processing. This is the invisible system that turns every single click, every swipe, and every sale into the financial story of a company. At its heart, a business is really just a constant stream of events. A customer buys something, an employee gets their paycheck, you buy some raw materials. The real magic, and what this course is all about, is how an accounting information system takes those countless little events and turns them into the structured financial statements we all rely on. So today, we're going to follow that journey from a single sale all the way to the bottom line. So, first things first, what are we actually tracking here? We're focused on what we call financial transactions. Now, this is any economic event, and I mean any, that changes a company's financial position. It could be selling a product, sure, but it could also be something like an asset depreciating over time. You can really think of it as the fundamental building block, the atom of all accounting. But here's the thing. A big company can have thousands, maybe even millions of these transactions every single day. So how on earth do they manage all of that data without everything just descending into total chaos? How do they make sure every last event is captured correctly? Well, that's the core problem that a transaction processing system, or TPS, is designed to solve. Now, to make sense of it all, businesses don't just look at each transaction one by one in isolation. That would be impossible. Instead, they group them into logical cycles. So let's zoom out for a second and look at the big picture. Believe it or not, every single business, whether it's a massive car manufacturer or your local coffee shop, operates on this exact same rhythm. First up is the expenditure cycle. You spend cash to get stuff, materials, labor, equipment, you name it. Then comes the conversion cycle. You take all that stuff and you turn it into something valuable, like building a car or brewing a coffee. And finally, the revenue cycle. You sell that product or service to get cash, which, guess what? It flows right back to the beginning to start all over again. It's truly the circle of business life. Okay, so to keep track of absolutely everything happening in those cycles, every purchase order, every sale, every payroll check, a modern system uses a set of digital files. The best way to think about this is like a highly organized, super intelligent digital filing cabinet. It is the absolute backbone of the entire accounting system. So, let's start with the most basic question. Where does the system store the core information that doesn't really change day to day, like, say, your list of customers or your complete inventory catalog? That is the job of the master file. And the key word here, the one to remember, is permanent. A customer's account exists in that master file, whether they bought something today or a year ago. It's the system's main ledger, the single source of truth for all the company's core data about its customers, its vendors, its inventory, all the big stuff. Okay, that makes sense. The master file holds the big, permanent accounts. But where do we capture that constant, messy stream of daily activity before it gets posted to those main accounts? That would be the transaction file. This is the system's daily journal. I like to think of it as a temporary holding pen, where all the events of the day, every sale, every payment, get recorded as they happen. Its whole purpose is just to collect this data so it can then be used to update the master file later. But hang on a second. When you process a sale, the system needs to know a bunch of standard information, right? Like, how much does this product actually cost? What's this particular customer's credit limit? Where does it find that info? It looks it up in a reference file. This is basically the system's rulebook. It holds all the standard lookup data that's needed to process transactions consistently. We're talking price lists, tax tables, shipping rates, the whole deal. And the crucial point here is that this ensures that every single transaction is processed using the same, correct, authorized information. No guesswork. Okay, so last piece of this puzzle. After a transaction is processed and the master file is all updated, what happens to that original record? I mean, we can't just delete it, right? Businesses need a permanent historical record for things like auditing and analysis. That record goes into the archive file. This is the permanent historical journal of the company. And let me tell you, for accountants and especially for auditors, this file is pure gold. It forms the core of the audit trail, which allows us to trace any number on the financial statements all the way back to the original source transaction that created it. All right, we've seen all the individual components. Now, let's put them all together. We're going to follow the data from a single sale just to see how these different files all interact in the real world. It all begins right here. A customer decides they want to buy something. They might fill out an old-school sales order form, but more likely these days, they're just clicking checkout on a website. This right here is the source document, the trigger for the entire process. The instant that order is entered, the system captures it, and it does that by creating a brand new record in a transaction file. Just like that, the event is now officially inside the system, just waiting to be processed. Next, the system uses that new transaction record to update the permanent master files. And two really important things happen here. One, the customer's balance in the accounts receivable master file goes up. And two, the quantity of that product in the inventory master file goes down. The core records of the business have now been officially changed. And once those updates are complete, the transaction record itself is moved from that temporary transaction file to the permanent archive file. It's now officially part of the unchangeable history of the company. It's become part of the digital sales journal. Now, that whole process we just walked through, it can happen in two fundamentally different ways. And it all comes down to one thing: timing. Do you process transactions one by one as they happen, or do you group them all up and process them all at once? Let's compare the two. With batch processing, you collect transactions and run them later in a big group. A perfect example is processing payroll at the end of the month. It's way more resource efficient, but the information is always a bit delayed. On the other hand, real-time processing handles each transaction the very moment it occurs. Think about booking a flight or using an ATM. The data is always perfectly current, but it requires a much more powerful and expensive system that has to be on 24/7. In this quote right here, it really just nails the key takeaway. The choice isn't about which one is better. It's a strategic trade-off. You have to ask, does the user need live up-to-the-second information? If the answer is yes, you have to go with real-time. But if a little bit of a delay is okay and you can gain some efficiency, then batch is probably the smarter way to go. So let's bring this all home. Why does this structure of files and processes matter so much to us as future accountants? Well, it's because this whole system creates the modern audit trail. This entire system we've just walked through, it's not just about being operationally efficient. It's designed for verifiability. This digital flow creates an unbroken chain of evidence. An auditor can start with a single number on the balance sheet, trace it back to the master file, then find the specific transaction in the archive file, and follow it all the way back to the original source document. That is how we prove the numbers are real. And that leaves us with a really fascinating question for the future, for your careers. We're moving pretty fast into an era where AI can automatically categorize and code transactions without any human ever touching them. So what does that mean for the audit trail? How do we audit a decision that was made by an algorithm? That is a huge challenge that the next generation of accountants, you are going to have to solve.